Welcome to the Daily Update. This is being prepared Wednesday, March 23rd, where we'll look at the action in the market today and then see how things look for Thursday, March 24th. And it was a bit of a pullback day. We had been quite overextended on a short-term basis, plus we were hitting overhead resistance. And so to see a pullback was not necessarily a surprise. It's kind of what I've been talking about in my video updates. However, we fell back through critical support. We got through the 200-day moving average only to have us fall back through it on Wednesday. Now, that's a very important moving average, especially the simple moving average. Both are important, but a lot of investors tend to use the simple moving average because that's the key between a bull market and a bear market, if you will. And to go above it and then to come back down. But there are some encouraging signs at the same time. Volume really declined on Wednesday. So to have a down day on decreased volume and volume that has been declining over the last few days, it was a little bit of a warning sign after Tuesday because we were up on below average volume. It's a little more encouraging to have a down day and be even more of a decline in volume. So I'll go through and show you the charts and see how these things look. So to kind of go over what happened on Wednesday, we did have a gap lower open. Oil was really up strong. And if you project back about 4 or 5 years, when oil was really going up at that time, the stock market was going up at that time. The two were going together. Well, now there's more of a decoupling and they like to go in inverse directions. If oil is going up, because it's going up so far, so fast, that's starting to really spook the bond market. Plus, we have a high inflationary environment now that we didn't have a few years ago. And we're seeing some really interesting things like the dollar might go up and gold goes up, or both go down, or usually they go in opposite directions. And so there's some real contradictions based on what usually happens that we're following right now just to get a handle on what's happening. But we gapped lower at the open, we dropped right down, but then there was an attempt at a rebound and we came right back up to resistance. And I'll show you that on the intraday chart, where it's a line that I had on the intraday chart weeks ago. Well, that's turning out to be kind of a critical level. As we went throughout the trading session, prices moved sideways kind of along that line and then sank from there. I was watching things and I was quite encouraged when I saw things just moving sideways along what had been resistance. We broke through that, now it had become support, but it took on more of a negative flare when we sank below that support level. There was some late day selling that came in right at the last 10 minutes, and we ended up closing at the low. We were down 1.23%. We were below average with our volume, and it's been declining over the last few days. That shows a real lack of conviction. We saw a decline with an up day, and now we've seen a decline in volume on a down day. It's like, okay, who's in control here? The technicals are still pretty positive overall, but showing a little bit of weakness after Wednesday's session. We're coming up close to the end of earnings season. Everybody's talking about inflation and fixated on that, not only from a market sense, but in a real life sense, a personal sense. And there's still the geopolitical concerns, Russia, Ukraine, what's going on in China that might affect the US economy overall with some of the lockdowns and some of the things happening there. Their market is bouncing up a little bit and showing some improvement. But with the lockdowns, with the things going on there, what's that going to do to the supply chain that it was already a problem. Is that going to even have a bigger impact on things? So some of the comments that we can make is we're still out of correction territory. We're not down 10% from the high, and I'll show you that. The technicals are positive, but after Wednesday's session did weaken slightly. They didn't change. They're just showing a little bit of weakness. We lost the 200-day moving average again. Prices still remain in a range, and if we have some up days going forward, we're still getting close to that previous short-term double top that caused some problems not too long ago. And again, I'll show you that on the chart. Then the geopolitical concern, Russia, Ukraine, inflation, interest rates, China. We did have an economic report, not a real influential report, but it showed that new home sales did decline in the latest report. Valuation, if you take the S&P by itself and just look at some different indicators, it's still overvalued. When you look at an intermarket analysis type approach, where mainly you're comparing it with interest rates, the market or the S&P is more fairly valued. It just depends on what your personal focus is. I look at both. I focus more on the S&P itself, but I also use intermarket analysis a lot. The trend is positive, but could be weakening because we saw, 1.25% decline. That's doesn't seem like a big move. You look at it on the chart, it doesn't seem like much, but compared to the wild swings that we have had, it is weakening the positive trend. And the bias, I should have changed that. We switched over to negative with the down day. So that's incorrect on the slide, but the momentum overall still continues to be positive. Let's look at the day's session. First, we look at sentiment. And for some reason, the CNN site went back to their old charts again. Who knows what I'll find tomorrow, but we're getting close to more neutral territory. We were extreme fear, and that's when we hit bottom, it looks like, and then we came up out of that. Well, as we've been going higher and higher, most investors are becoming less and less fearful, and we're getting back more. We're still balanced over towards fear, but it's more in neutral territory. It was actually declined 1 point. It was 44 after Tuesday. It's 43 now after Wednesday. And here's the chart. And this is the chart I like better because they just show this better. Here's the bottom that we came up out of, and we're working off that extreme pessimism that we had and getting more into a neutral territory. As far as the VIX, one thing, since I didn't do a daily video yesterday, I just went over the high points because I'm having such problems with my voice right now. Even though we had an up day, the VIX didn't really decline all that much. If you can see this on a closing basis, go back one bar. We were up over 1% on Tuesday, but the VIX really didn't decline all that much. You would expect to see it fall. So that means that at least in the very, very short term, just within a few days, they're not taking a lot of the hedging off of positions. And then it advanced slightly on a closing basis. Again, we had more than a 1% down move right here, but the VIX didn't really advance all that much. And you see a really small bar here. So that just, again, shows a lot of indecisiveness right now. We have a big up day, the VIX doesn't really decline. We have more than 1% decline, the VIX doesn't really advance. Then the VIX of the VIX is pretty much going sideways on the daily chart and pretty much went sideways on a closing basis as well. The Ulcer index or indicator, we're dropping. I just include this every day just to show, is fear rising or is it declining? Well, it still shows that overall we are declining. As far as the sectors, 9 out of the 11 were negative. The biggest downward sector was financial, And then all the other ones, tech, the usual suspects here. The two that were up were utilities and energy. And those have been more, well, energy, of course, because of oil prices and heating oil and all the other stuff. But utilities have been really outperforming bonds quite a bit, where people that are more dividend type investors, they would look to getting into more of these kinds of investments. And then this, and I'm going to have to try to pause this. Okay, I hit the wrong button there, and I was supposed to try to pause this, and I hit the right thing. Okay, I apologize for that. I had it all figured out what buttons to push if I have a coughing fit, and obviously that didn't work the way as I planned. But energy is still doing the best if we go back to the all-time high. But look at now what's in last place. We have communications. Discretionary has been bouncing, still down, and it's in second to last, but it had been the caboose sector for quite a while. But these, over the last few days, have changed places with each other. Then another thing I wanted to bring up, this is just a chart of the tech sector, because I know a lot of you that watch this, you also invest in tech. Tech is a huge part of the S&P 500. And so sometimes I'll go through and I'll bring up individual sector charts. Well, here's the tech sector where we've been going down, as we've been talking about, and they were down 1.5% on Wednesday. Well, we came right back up to the 200-day moving average, and now we're bouncing below that. Now, even though some of the indexes that we follow did break through the 200-day moving average, we want to keep an eye on this chart. If we have an up day, if we see some strength in the market, can the tech sector get back above this 200-day moving average? As far as inflation, the CRB, it was up 2.41%. It dropped off a little bit and has now regained its upward movement and is in an overall uptrend. And this is really what we're seeing as far as inflation is concerned. If the CRB is going up, by and large, that means inflation's going up as well. And then just to show you some of the different commodities, aluminum, it, after falling back for a few days, well, it shot up 4.83% on Wednesday. Gas, after falling back, was up almost 3.5% on Wednesday. Here we have heating oil, after falling back, was up over 6% on Wednesday. Wheat, which again, we're really watching closely because a lot of that involves Russia and Ukraine. And that also involves fertilizer prices, which I don't have a chart of that right now. But this will feed more over into the food inflation that some of you are already seeing pretty big right now. It actually declined a little bit, but had been spiking up. So we want to keep an eye on this as well. The technical alerts that were generated on Wednesday, I start at the bottom. First, we went below 4,500. And that's, let's see, the S&P 500 BPI across below 70. According to this, that is now, first it crossed above, then it went below. I'm not really showing that. I use different parameters in the chart that I will show you. But once it went above, that's the first part of an overbought signal. When it crosses below, that's the second part. Now my goodness. When both of those are taken together, now that is an overbought signal. The NASDAQ was dancing all over, sometimes higher, sometimes lower, and oil was able to get back above 110, and I'll show you that in the chart. The euro, the dollar's still been doing well. It's been holding up, and especially against the euro. And as the dollar gets closer to 100 and the euro comes down, it's going to be interesting to see if these two meet at some point, because the euro has been anywhere from 10 to 20% greater than the dollar for quite some time now. Okay, here's the intraday chart. We did gap lower, and which is not surprising. When I saw this, I'm like, okay, this is pretty much what we expected. And then we bounced back up to this level, and this is the support or whatever you want to call it. Is this line has been here for quite a while, and we danced along that for most of the day. But then as we went on, we started to break a little lower. Now, we didn't break big time lower, and we even tried to recover up out of that, and it looked like, okay, this is just going to be a normal day. But then we saw some pretty hefty selling going right into the close, and we ended up closing at the low for the session. I'm going to try this again. Okay, it's not letting me pause this. Okay, well, sorry about that. All right, I hope I won't cough too much here. Here's what the daily chart looks like, where, and I pointed this out in even the snapshot videos, where we are dealing with some pretty hefty resistance right now. I have to pause this. Okay, I apologize for that again. The resistance that we have right here, I marked this, that this had been support in the past. Well, when we broke through that, now this becomes resistance, and we came right up to that level, and we've been bouncing down. The question now is, are we going to continue lower, or can we turn things around and break through? And then we have this other double top, this short-term double top that I've been talking about. We have that as overhead resistance, and we also have R1 just about at that same level. So there is some real significant overhead resistance ahead of us if we go higher. Now, if we start to break lower, that's going to change the technical picture. Also, if you notice, you see how volume has been just dropping off. We had a huge day on Friday, but then boing, boing, boing. As the week goes on, we're seeing less and less volume, regardless of if it's an up day or a down day. We're down 7.10% right now. Here's the all-time high set back in January. Here's where we're at right now. We saw a bit of a decline with growth and a bit of an advance based on value. Here is the indexes showing the growth index has been improving, even though it declined on Wednesday. We've been able to get back above the 50-period moving average, but we're dealing with a recent death cross. Here's the inverse of that same chart, where value has an overall uptrend, but has been declining and broke through the 50-period moving average. Here's the NASDAQ 100. It's coming right up to what could be resistance, right at this 50-day moving average. And so far, we haven't even touched that yet before we saw a pullback. As far as our trend here, this is what's kind of interesting. The ADX did cross over positive, and the buying power is still increasing. The selling power is going sideways, but we're seeing the ADX weaken overall. Again, please remember that the ADX does not show us the trend. It just shows us the strength of a trend. When this is going up, that means the trend is getting stronger. When it's going down, that means the trend is getting weaker. The green on top means that this is now positive, where before it had been negative for quite some time. So we are seeing a weakening trend. The Arun, which looked quite positive after Tuesday's session, it boomed all the way to the top. And that's what we want to see if you're bullish on the market. Well, it tapered off a bit, as to be expected, but we're still seeing a decrease in selling pressure as well. But from Tuesday to Wednesday, it was flat. However, the Arun has crossed above zero, so that is positive. Then we're coming off of this recent Pring bottom fisher signal, and that is still headed higher, even with the decline. And just while I see it here, you notice how we got above the 200-day moving average? Well, now we broke below the 200-day moving average for the S&P. The decision point charts, they were finally updated, just showing on a short-term basis, both the trend model and the PMO signals are positive. Still negative, intermediate term, neutral based on the trend model, but long term, still positive. Looking at the breadths with the down day, we saw more of a decline based on price and volume. So our top line declined a bit, but is still above the moving average. The bottom line is below the moving average, with the moving average going down, and we saw a bit of a decline there. The advanced decline ratio, it's still above this line here, so it's somewhat positive, but did decline on Wednesday. New highs and new lows, tapering off a bit, but still in an overall uptrend based on both of our moving averages. Accumulation distribution declined a little bit on Wednesday, but still above the moving average, with the moving average going higher. Short term, we're well above the 20-period moving averages. And as time goes by, these moving averages will likely get closer and closer to price. Our moving average study, this is part of the short-term overextended reference that I was making, where we shot up positive and now we're falling back. With the decline based on the 50, we saw a bit of a decline there in this indicator and a bit of a decline in the 200. Then our moving average spaghetti tree here, these, and this is hard to read because of all the lines, but we were able to come back. First of all, we got above the 200-day EMA because that calculates quicker. Then we were able to get above the 200-day SMA. Well, we came back down below it, and we also have the 100 in this picture. That's this gold line right here, and we're just a little bit below the 100-period moving average. And I have a chart of that I'll show here in just a moment. The MACD continues to be positive, even though it declined a little bit based on the histogram. The STO with the decline is showing that here based on price and volume. McClellan oscillator, which also have been giving us a really extreme positive reading, it's now fallen back. Stochh RSI has been pegged positive for a while. Same thing with the Williams %R, but this one is looking like it could come down a little bit. The force index, which is also pretty touchy, it was giving us an extreme reading X, and it went outside of this moving average envelope. That's because we went up pretty far, pretty fast. So now we're pulling back, and it actually is down here as far as the force index is concerned. But we just showed a lot of quick upward movement. Intermediate term, here's the 50-period moving average, where they're starting to cross over themselves. Remember, this is an exponential moving average in blue and a simple moving average in red. And it will not let me pause this. Okay, I have the key combination here that's supposed to let me pause it, and I hit those buttons and I hear the bring that you usually hear coming out of a Windows computer. But this could be positive. Generally, when the blue line is below the red, that's more negative. Well, if we could see the blue line cross back above, because it calculates a little bit slower, that could be a positive thing. And then the next chart is the 100-day moving average, where we never got back to the 100-day simple moving average, but we were able to get back above the exponential. We climbed above that. Well, we closed just down below that. The 100 is probably one of the least important moving averages. I just use it when we're going sideways. And we've been doing a lot of sideways range trading lately, so that's why we're looking at it more. The PMO is still looking okay. It's going up, also based on price and volume. So that oscillator is still good. Again, one of our shorter term signals, those PMOs that are rising, was giving us an extreme positive reading, and we're coming back down off of that. Those that are giving buy signals, it's also going into extreme positive territory. And then those that are above zero is still advancing. And then this is kind of what they were talking about with the technical alerts. We just barely got it. It's a really small bar. It's hard to see. So there wasn't a real big change on this. It went slightly above 70, only to come right back down below it. And then here's the longer term view of that as well. Then our rainbow, we've been trying to cut up from the underside of it all. but we still have a ways to go, and we need to stay above all these moving averages for it to turn back into a nice, pretty little rainbow again. Stochastics also telling us short term, we are overbought. We fell back down on the short term. Even the intermediate term is rolling over a bit, but the longer term stochastic is still advancing itself. Here's the 5-day rate of change. It had given us a recent extreme reading. Well, now we're coming back down off of that. And then looking back 10 periods, also, it gave us an extreme positive reading, and we're coming back down off of that. So right now, my personal interpretation of this is we went up really far, really fast. So we're pulling back. The question mark is this just going to be a little bit of a pullback before we get set to go higher? Or is this going to turn out to be a fake rally where we're getting ready now to go back down to lower levels? We don't know that right now, but we have to play for that scenario just in case. Then our summation index is still positive based on price and volume. Our oscillators, even though some of them weakened slightly on Wednesday, they are still positive. The vortex is still positive, but we saw a bit of a decline on the green line and a bit of an advance with the red line. The RSI is still above 50, but did decline. The CCI also giving us an extreme reading and coming down off of that. And then the 20 period giving us an extreme reading and getting ready to cross below to give a signal. Standard deviation, we're getting, because of this really strong up move that we saw, we're getting kind of far away from the standard or the normal price. So the fact that we're pulling back right now should not necessarily be surprising. Prices want to try to hug this moving average right here. And when we get too far away, it's like a dog on a leash, you bring them back in type of a thing. Well, this could still go higher, but don't be surprised if we see this come down a bit. Then the Chaikin oscillator also giving us a recent extreme reading and then coming down off of that. Chaikin money flow is still advancing. The percent B, this was giving us almost an extreme positive reading 2 times. And now with the decline on Wednesday is pulling back a little bit. Our trading systems, the Elder switched back to neutral, but notice how it had all these green bars. Then we see a down day and it goes back to neutral. The SAR continues to be positive with the dots below. Our different charts, the Heikin Ashi, even though we had the down day, this candle is still open. So that is still positive overall. The Kegi is also showing some improvement. The black line's a little bit higher than it was before. The Renko is putting in recent moves with open blocks that's more positive. 3-line break is also still looking positive. Equi-volume, just showing the little bit of the down day after seeing some really nice advances. Point and figure generated a recent signal a few days ago that could be pointing to a double top breakout right here. Well, with the decline on Wednesday, nothing new was drawn. We're going to need to see prices go higher to get some new X's in here to have things turn more positive. Fibonacci, we're still back above the 38.2% retracement level and still could come down. That's right at about 4,400 right now. So what, 56 points away roughly from where we're at right now, but we have been able to retrace back through that level, at least to this point. Long term, we've now dropped below the 200-day moving average, both based on the arithmetic scale and the logarithmic scale. The mega caps, they were down 1.5% almost. They've been really declining lately, but trying to bounce up out of that. The special K is trying to turn up, but we're still below the moving average. And here's the longer term view. Then our moving average study, longer term, we're looking at the 50 period. We're coming back down, not after an extreme positive reading, but we were pretty high here, and we're coming back down. The 150 period moving average, it came almost back up to this level before turning down, and the 200 day is also turning back down now after breaking out. Looking at the broad market, here is the S&P. The mid caps, they're still more within this range, and the small caps didn't have as much of a breakout as we had before. Again, going back to what I pointed out a number of videos ago, and I need to pause this again. We were looking at the small caps because they seem to bounce up, and sometimes, not all the time, but sometimes that can lead things like the S&P 500 higher, and that appears to be what has happened. Well, that's kind of in the rear view mirror now. It's not as big of a deal as it was before, and the small caps are now getting back into the range that they were trying to get out of. The FANG stocks, really, for having a down day like we had, they were only down 0.2%. And they've been really climbing nicely, and we're able to regain the 50 period moving average. ARC was down 1.94% after also trying to have a nice bounce, came up to the 50 period moving average almost, and now we're falling back a bit. The Dow, again, this was looking more positive. We were able to get above the 50 period moving average. We stayed above that. We never got to the 200 day moving average, but now we've fallen back down below the 50 period moving average. Small caps, after coming up almost to the 200 day moving average, have now fallen back, but we're still above the 50 period moving average. Mid caps, kind of the same thing. They tried to break through the 200, did not do that successfully, but then fell back. NASDAQ has been able to stay above its 50 period moving average, but we still have a lot of real estate before we get to the 200 day moving average. NASDAQ 100, kind of the same thing, still above the 50, but a long ways to go before we get to the 200. The Vixen, kind of a similar situation where we saw a pretty solid up day on Tuesday, but the Vixen didn't really decline. And then we see a decline, and the Vixen really didn't advance. Kind of interesting. NYSE, we're able to get above the 50, but now we've fallen back below, I'm sorry, the 200, but now we've fallen back below that, but we're still above the 50. The S&P 100 is, at least continues to outperform the S&P. See how it's gone up rather nicely lately, and it actually advanced slightly on Wednesday. Wilshire got above the 50 period, never made it up to the 200, still above the pivot, but we fell back down again. China is trying to bottom and turn up, as are all the other markets. Some of them have actually crossed back over positive, with the S&P kind of showing the most strength right now. Looking at our all stocks, we came right up to the 50 period moving average. Now we've broken slightly down below it. And then this is another chart that I started including, but since I haven't done full-blown videos, I haven't shown you yet. These are world stocks outside of the US, just to give us some non-domestic exposure here, where we've been in a downtrend overall and we declined 2%. And we are in a, well, the 50 period is below the 200 here, and price is below both of those. Some broad market indexes, here's the dollar. It was up on Wednesday and is still in an overall uptrend. Here's the weekly chart thus far, also showing a pretty strong uptrend. Oil, which had screamed to 130, got down below 100. Well, now it's back up to almost 115. Gold shot up, came back down, and was up 0.82%. Here's the ETF of gold as well. And here's the longer term ETF for gold. Silver, kind of the same thing, but look at here, we're seeing a potential golden cross. This has been developing for quite some time now. And so as long as price stays above these moving averages, this cross will continue. Then here's the longer term look at the silver ETF. Bitcoin still down around the low 40s for right now. As far as the bonds, we're still coming down here to this red line, which we're trying to figure out, what does that mean? We have some people saying, yes, we know a recession is going to occur. And you have other people saying, no, a recession is not going to occur. We look at the charts, and this is still suggesting that we're seeing some real economic slowdown right now. Whether it's going to lead to a recession or not, that has still yet to be determined. Here's the 30-year yield where we broke above this 50% retracement. And here's the 10-year yield where we broke above the 61.8 a few days ago. And we're getting quite up into a lot of clear sky right now as far as interest rates going higher. Here are the yields overall. We did see a decline in the 30, and then the 10 and the 2 are just, they're flip-flopping. They're sometimes inverted, sometimes together, sometimes a little bit apart. And that's kind of the real tug of war that's going on right now, where the 2-year declined in interest rates and the 3-month also. Internationally, we're seeing an overall advance in interest rates. Based on price, we continue to see a decline overall with some potential support. Where we're at, we could drop a little bit lower, but these are some levels that we're at right now where prices did advance. Now, if bonds turn around and go up based on price, that means they're going to go down based on interest rates. And are we really in that kind of an environment right now? It doesn't seem very likely because of inflation fears. The corporate bond index, after kind of bouncing around a little bit, it advanced on Wednesday, and the current yield is about 3.5%. Here's a longer term view of that same chart. Junk bonds, which tend to mimic more of the stock market, they are in an overall downtrend. Some of our relative studies, gold, after really shooting up, and then the S&P shot up as gold went down, so we came back down here. Well, we were up a bit. We're bouncing off of this 50-period moving average currently. Looking at energy against the S&P, again, shot up, fell back, advanced. We're seeing that kind of across the board with some of these things. Growth against bonds, where growth had been doing really well. Well, with the decline on Wednesday, it also declined. And then looking at tech against the S&P. Now, the first chart that I showed a while ago, that was just tech all by itself. This is tech compared to the S&P 500, where we're underneath the moving average and we have a ways to go to get back to that, even though we have bounced pretty nicely. Then looking at tech against the 10-year. Well, tech really declined on Wednesday. Interest rates are gyrating all over, so tech continues to be impacted by higher interest rates. And this is just an inverse of that same thing. We're seeing a breakout of interest rates and a breakdown of tech. Looking at discretionary against staples, where we broke back above the 50, but we're seeing some slight decline right now overall. And then the S&P with the 10-year yield, where it's been bouncing kind of nicely. And we saw a bit of an advance on Wednesday. That's not right. We were in a decline overall with a little bit of a bounce on Wednesday. Then this is another new chart. This is taking low volatility stocks. These are the kind of stocks you generally want to be in when we hit a lot of trouble. See, when we hit the all-time high in early 2022, see now this is the comparison between the two. I don't have the SPLV all by itself, but they have really outperformed the S&P itself. Well, now it's pulling back slightly, but with the decline, this saw a bit of an update. And then this is the one I just wanted to include it here because we're kind of out of this now, but where the small caps had hit bottom and started to bounce up, and then not long after that, we saw the S&P bounce up. So what are we looking for on Thursday? We're still out of correction territory. We're still in a range. If we go up, we're still getting close to that short-term double top. We still have earnings. We still have the battle between growth and value. We have a lot of economic reports coming out with jobless claims, durable goods, the current account balance, which is not a biggie. Yeah, it's going to go up. And the preliminary March IHS Market Manufacturing PMI, Purchasing Managers Index, and then all the other geopolitical events. The one that I added to this, because the president is in Europe now and going to be meeting with NATO concerning the whole Ukraine-Russia situation, that is what it is. It's just something to be aware of. Whether positive things or negative things are going to happen, we'll just have to see how that goes. So, and that could have some kind of an influence on the market. Then looking at our different scenarios, if we're looking for things to go down or negative, are we still looking at a reversion to the previous trend? Before the Fed raised interest rates, the trend was down. Are we working off an extreme negative condition before we get set to go lower? And again, as I keep pointing out, as we go day after day away from that, it becomes less and less likely. But we're looking at a short-term overbought situation that we pulled back from on Wednesday, and overhead resistance from where we're at right now. Hitting that overbought situation and that resistance, that could push prices down. And it did on Wednesday. The thing now is it going to continue on Thursday? To look at the positive side of things, we can pretty much say now that that is a base that we're coming out of. Even if it turns out to be a fake, it's up high enough and has lasted long enough, in my opinion, so that that is a base. Now, it may ultimately fail, or it may go higher, but it looks like that was a base that we came up out of. The oscillators continue to be positive, even though we showed some weakness. The moving averages are providing support and resistance, depending on the perspective. And then we have to be aware of sideways. Now, we're not really in danger of that happening now because we've seen such wild swings. We've had 1, 2, almost 3% up and down days over the last few months. We want more of a sleepy market that's not really going anywhere before we look at initiating credit spreads and iron condors and more market neutral type of strategies. And then what we would look for in that case is a price movement slowdown, which ends up becoming trendless with the ADX really dropping below 20 and going sideways. We're not getting to that point now. We just want to be watching for that all the time. So our overview is the S&P is positive, but it's still in a range, even though we had an up day. Short term, it is positive, but pulling back after being at some overbought levels and still having overhead resistance. Intermediate term, we are still positive. Our oscillators are positive. Some of our moving averages are providing support and some are providing resistance. Long term, we're now back under the 200-day SMA. The longer we stay underneath that, the more that red line is in danger of rolling over. So thank you very much for putting up with my pauses and coughs and things. I hope you have a great day, and I will talk to you again after Thursday's session.